morning, friends. I am Dr. Manarubi, Assistant Professor in the Department of Economics. Friends, in today's class, we are going to discuss about the derivative market options and futures. So first, we will discuss about the uses of derivatives. Then we will concentrate on the derivative markets, options, and futures. Then we will focus on types of options, then types of futures. In the end, we will discuss about the keywords and the terminal questions. Let us concentrate on the use of derivatives. See, a derivative is referred to as a security or financial instrument that depends or derives its value from an underlying asset or group of assets. They are simply contracting between two or more parties. The value of such a contract is determined by changes or fluctuations in the asset where it derives its value from. The derivatives market is where these instruments are traded. Usually, the underlying assets used in derivatives are bonds, stocks, or commodities, currencies, market indexes, as well as interest rates. Then let us concentrate on the derivative markets, options, and futures. See, futures are financial contracts obligating the buyer to purchase an asset or the seller to sell an asset such as a physical commodity or financial instrument at a predetermined future date and price. Future contracts retail the quality and quantity of the underlying asset. They are standardized to facilitate trading on a future exchange. Derivatives are used by various sectors for hedging purposes. The banks use these contracts to protect themselves from fluctuations in the interest rate. Airline companies haven from futures to lock in the price of oil when it is at low levels. For example, Southwest Airlines have done a great deal in locking the price of oil to 10 each barrel, even if the price had already climbed to over 100. Let us concentrate on the types of options. An options contract gives an investor the right, but not the obligation, to buy shares at a specific price at any time, as long as the contract is in efficient effect. By contrast, a future contract requires a buyer to purchase shares and a seller to sell them on a specific future date, unless the holder's position is closed before the expiration date. Options and futures are both financial products investors can use to make money or to help current investments. Both an option and a future allow an investor to buy an investment at a specific price by a specific date. But the markets for these two products are very different in how they work and how risky they are to the investor. So these are many types of options in the stock market. So there are broadly two types of options. One is call option, second one is put option. First, let us concentrate on the call option. A call option contract is a simple terms. In simple terms, is the right to buy. It gives the owner of this contract the right to buy a stock at an agreed upon price. It is also known as strike price at any time before or an expiration date. This options type is bought when the investor expects the market price of the stock to rise in the future. When the market price goes up, the contract holder can exercise their option and buy the stock at the strike price, which is below the market price at the time, thereby making a profit. The next one is put option. See, conversely, a put option gives the owner a right to sell. A put holder can sell as a stock at a strike price within the expiration date. When an investor expects the market price to fall in the future, that's when they place a put option. As the market price of the underlying asset falls, the put holder can exercise their right to sell it at the strike price, which is higher than the market price at the time. Thus, the investor makes a profit. So let us concentrate on the call and put options. There are only two kinds of options. One is call option and another one is put option. Already we have discussed. A call option is an offer to buy a stock at the strike price before the agreement expires. A put option is an offer to sell a stock at a specific price. So let's look at an example of each first on a call option. An investor opens a call option to buy stock XYZ at a 50 strike price sometime within the next 3 months. The stock is currently trading at 49. If the stock jumps to 60, the call buyer can exercise the right to buy the stock at 50. That buyer can then immediately sell the stock for 60 for a 10 profit per share, right? Now let us concentrate on types of futures. A futures contract is an obligation to sell or buy an asset later at an agreed upon price. Future contracts are a true hedge investment and are most understandable when considered in terms of commodities like corn or oil. So for example, a farmer may want to lock in an acceptable price upfront in the case of market prices fall before the crop can be delivered. The buyer also wants to lock in a price upfront. So if the price is assured by the time the crop is delivered. Let us give an example. So let us demonstrate this with the help of an example. So you assume that there are two traders. They agree to a 50 per percent price on a commodity future contract. If the prices of commodity moves up to 55, the contract or the buyer of the contract makes 5 per barrel. The seller, on the other hand, losses out on a better deal. The market for futures has expanded greatly beyond oil and corn. Stock futures can be purchased on individual stocks or an index, like the S&P 500. The buyer of a future contract is not required to pay the full amount of the contract upfront. A percentage of the price called an initial margin is paid. So, for example, an oil futures contract is for 1000 barrels for half oil. An agreement to buy an oil futures contract at 100 represents the equivalent of a 1 lakh agreement. So the buyer may be required to pay several $1000s for a contract and may owe more if that bet on the direction of the market proves to be wrong. Then let us concentrate on the summary of this part. The derivatives market refers to the financial market for financial instruments such as futures, contracts, or options. There are 4 kinds of particular participants in this derivative market. One is hedgers, second one is speculators, third one is arbitrators, and the fourth one is margin traders. So these are the main types of derivative contracts. Thank you, students. So these are the important aspects in the today's class. Thank you.